Here's something most people never hear after they file. Filing your return isn't the end of tax season. It's actually the beginning of a window that matters most. Between now and December 31st, there are 3 moves available to people in their 60s that don't show up on any return, and most advisors simply aren't bringing them up. There's a new deduction that stacks on top of your standard deduction, a retirement contribution window only open to people between the ages of 60 and 63, and a healthcare subsidy rule that changed on January 1st of 2026 that a lot of people built their retirement income plans around the old version of. I'm Tim Gardner, Wealth Manager at Chatham Wealth Management. And by the end of this video, you're going to know exactly which of these 3 windows is open to your situation right now, and what needs to happen before December 31st closes that window. Hey, rarely does the IRS hand you something new, but this one is for real. Starting in 2025, there's a new $6,000 deduction available to taxpayers 65 years of age and older. It stacks on top of your standard deduction, and you don't have to itemize to get it. It just sits there, available, and most people in your age range have no idea it exists. Hey, now if you're watching and you're 60, 61, 62, stay with me on this one. You're not there yet, but you're close. And the planning decisions you make in the next few years determine whether you're going to walk into 65 fully positioned to capture this, or whether you get there and find out you've been doing things in a way that actually phases it out for you. Now, before I show you how it works, there are 4 things that trip up people every time I explain this. And if you don't understand them, you'll think you're getting $6,000 when you might be getting just a little less. Misconception number 1 is it's a deduction and not an exemption. A deduction lowers your taxable income. It doesn't wipe out your bill. At a 22% tax rate, a $6,000 deduction puts $1,320 back in your pocket. That's real money, but it's not $6,000 back. And people who assume get kind of a nasty surprise. And it's not the only number that surprises people, because there is a phase-out built into the deduction that most people never see coming, and it's already shrinking the benefit for many high-income retirees. Misconception number 2 is there's a phase-out that most people don't see coming. You see, at a certain income level, this deduction starts shrinking. Doesn't disappear overnight, but it does taper off. If you're in a higher income range, and you assume you're getting the full $6,000, run the actual numbers, or have someone run them for you. Misconception number 3 is the double deduction confusion. This stacks on top of the standard deduction. It doesn't replace it. But how it interacts with other deductions you might be taking creates more confusion than you'd expect. I've had clients come in thinking they're already accounting for it when they hadn't, and vice versa. Misconception number 4 is the filing status trap. Married filing jointly gets a different outcome than married filing separately. If you or your spouse file separately for any reason, and some people do for some very legitimate planning reasons, the math changes. Don't assume. At 22%, the full deduction puts $1,320 back into your pocket. That's not a rounding error. Now, here's the part that adds a little urgency beyond just this year. This deduction is scheduled to sunset in 2028. Does it mean it will? Not necessarily. Congress has extended provisions like this before, and it's entirely possible that they'll do it again. But what I do know for certain is that it exists right now, it's available right now, and if you qualify and don't take it, the money is gone for that year regardless of what happens in 2028. 2 clocks are ticking right now. The annual clock, use it or lose it this year, and the 2028 clock, which may or may not matter, but which makes planning around it now the smarter move either way. Hey, I put together a resource called the 2026 Retirement Bridge Strategy. It covers the frameworks like this, one for finding the tax moves that actually matter for your stage. Link is down below in the description. Back in January, I got a call from a client. I'll call him Mark. He's 60, a senior director, makes about $185,000 a year. He's been maxing out his 401k for 15 years. Disciplined, on autopilot, and his January paycheck just came up $250 short. He had no idea, and the thing he stumbled into accidentally turned out to be the highest catch-up limit he'll ever have access to in his lifetime. Hey, he was frustrated. He said, Dim, I haven't changed anything about my lifestyle. My take-home pay just dropped by $250 a month. My HR person says it's because my catch-up contribution is now a Roth by law. So why am I paying more in taxes just to save the same amount? Hey, I get it. It feels like a phantom tax hike. You didn't do anything wrong, and your paycheck is smaller. But once you see what's actually happening, this changes completely. You see, in 2025, Mark's catch-up contribution was pre-tax. And depending upon his bracket, that saved him somewhere between $1,500 and $2,000 in taxes a year. Now, in 2026, the law requires his catch-up contribution go into a Roth. He's still saving the same amount, but the deduction is now gone. Spread that out over 12 months, and that's exactly why his paycheck feels a little lighter. So I asked Mark a quick question. If I told you that when you retired, your tax bracket might jump, would you rather pay taxes now or pay them later? That's the real choice. Pay wholesale today or retail tomorrow. And that gap between the two options could be worth tens of thousands of dollars over a 20-year retirement. But here's what makes that choice even more consequential for Mark specifically. Because it's not just about the tax rate, it's about which bucket the money ends up in and what that bucket is actually worth when he needs it. Because Mark was about to find out he'd been building in the wrong one for 15 years without even knowing it. Mark thought he was getting hit with a tax hike when he really wasn't. He was being pushed into building a tax-free bucket, the thing he had been meaning to do for a couple of years now, but kept just putting off. But here's what Mark didn't realize when he called me. At 60, he's inside the window most people miss entirely. You see, the Secure Act 2.0 created what's called the Super Catch-Up. It's available only to people between the ages of 60 and 63. In 2026, his catch-up limit isn't just $7,500. It's $11,250. Mark didn't get hit with a tax hike. He accidentally supercharged his tax-free retirement account at the highest possible catch-up limit available to him in his lifetime. Hey, if you've been meaning to build savings outside of your tax-deferred accounts, this is your window. The age, the law, and the contribution limit all line up right now for you, between 60 and 63. After that, the limit drops back down. If your advisor hasn't brought this up and you're in that window, that's a conversation worth having. If this is the kind of thing that should be on your radar, and possibly your advisors, hit the like button. It helps more people find this. This third move is the one that concerns me most about people watching this video right now. Because the rules changed in 2026, and most people who think they're fine are going to find out next April that they really aren't. If you've watched my video on IRMA, the Medicare surcharge that jumps the moment your income crosses a specific threshold, this has the same principle. $1 over the line, and the cost just doesn't nudge up, it jumps. The ACA subsidy cliff works the exact same way. And as of January 1st of 2026, it's back. For the last 4 years, 2021 to 20, the cliff just didn't exist. The rules were softened during COVID and then just were extended. A lot of people have gotten used to those rules. A lot of people have built their retirement income plans around those rules. And those people are going to have a very expensive surprise. Here's what the cliff looks like now. For 2026, the subsidy cutoff is 400% of the federal poverty level. For individuals, that's roughly $62,600. For couples, it's roughly $84,600. So if a 62-year-old couple earns $84,600, they might pay about $600 a month in health insurance. If they earn $84,601, yes, $1 more, their subsidy vanishes. Their premium could jump to around $2,000 a month or more. That's more than a $16,000 a year additional cost from a single dollar of income. And most people don't find out they went over until they file their taxes the following April. By then, folks, the year's over. Every dollar is locked in and the damage, it's done. The people most at risk right now are the ones who spent the last 4 years under the old rules and just simply never recalibrated. They're not doing anything wrong. It's just that the rules have changed and nobody told them. So active monitoring between now and December 31st is the move to make. 3 things to do. Pull your 1099s from last year as your baseline. Track your projected income and meet with your CPA or advisor before the end of the year, not in April. Meet in October and November, you've got time to act. Just April's way too late. The 2026 Retirement Bridge Strategy Bundle covers the tax optimization piece of this in detail. Links below in the description. And if you want someone to look at your specific income, tell you whether you're at risk before year's end, that's exactly the kind of conversation I have with my clients. You can grab some time on my calendar using the link below. You see, here's what most people are going to do with what they just learned. Nothing. Not because they don't care, but because knowing a move exists and knowing whether it applies to your specific income, your accounts, your timeline, those are two completely different problems. All three of these moves have hard deadlines, yet none of them show up in the return you just filed. Your CPA, they've done their job. These are your moves to make. And knowing they exist is step one. But knowing whether they apply to your specific income, your accounts, your timeline, that's a completely different question. And that's exactly what the next video gets into. It's called the Retirement Income Fixes That Change Everything. And it covers how to structure your income in retirement so that the moves you're making now actually work the way they're intended to. Same cliffs, same traps, just the retirement side of the equation. And it's linked on the screen right now. Hey, I'm Tim Gardner, and I'll see you in the next video.